Carol Schleif is Chief Investment Officer at BMO Family Office. Carol, thank you so much for joining us. What is your take on these markets in the U.S., which continue to move higher, no matter how many people make the point of a small amount of stocks doing all that work?
Yeah, I think markets, first off, thanks for having me. Really appreciate being here. The markets really are looking towards a lot more focused on the Fed in the near term here, although we don't suspect that the Congressional House today will be any more successful than the senators were yesterday at trying to prize out of him when that first rate cut comes. But I think there were a couple pieces of good news in that relate back through to stocks and earnings progression and things like that. And part of it is that the Fed seems to be shifting a little bit in terms of focus on the other side of its mandate, which is to focus on making sure that employment doesn't fall off too quickly. And also the fact that the Fed seemed to put an underline under the fact that they really don't see the next move as a hike, but that at some point we'll start to see rate cuts. And that's positive, not just for those magnificent seven or the tech leaders, but also for a broadening out, hopefully. And we're hopeful that in this earnings season, you'll see more of that broadening out as investors are able to focus on the fact that there's a lot of industries actually doing really well in the United States.
And where would you see some of the strongest opportunities outside of technology? And what do you think of technology valuations at this point?
Well, technology valuations, a lot of people point to the fact that they are full, if not rich. But it's important to remember, too, that they have been producing the vast majority of the S&P earnings as well. So it's not like they're unsupportable by earnings progression. There'll be a lot of focus on those companies. But as far as broadening out, when you look at the big tech companies and the amount they're spending on infrastructure and on data centers, you've got to have those companies that are providing the components and goods for those. You can look at utilities in terms of the energy draw and their need to build out. So anybody tied into infrastructure build as well, because we do have a lot of programs in the United States aimed at bringing manufacturing back online, building roads, bridges, improving the grid. There's also a lot of stuff. You look at healthcare companies and discovery, there's been a lot of use cases built and already deployed behind the scenes for artificial intelligence over the last 5 to 10 years. And with rates potentially coming down, we can also look towards financial services to be a beneficiary of that.
So you're constructive on second quarter earnings season, which I think is now 1 day away. I think we get a couple of companies tomorrow. Pepsi, I believe, is one, and then the banks on Friday, and that's when we really get rolling. What kind of earnings growth are you looking for across the S&P 500?
We're suspecting, I think the average out there is looking for something in the 8 to 10%, because it's important to keep in mind that the base effect is that we're comparing against some pretty weak numbers last year. Because if you roll back psychologically to last year, a lot of companies were expecting there to be a recession. So they had pulled back on a lot of spending, and we expect that because that recession didn't occur, labor markets are coming into better control, labor increases, the cost increases to keep that labor force employed are not quite as high as they were last year. Shipping costs are a little bit better. So we're expecting high single digits, low double digits in terms of earnings growth on a broad swath of industry.
And you referenced this earlier in our conversation, but do you think these results can help perhaps move some investment flows into sectors other than tech? We would get that long-awaited broadening out, which it's been fitful in the past. When we see broadening, we tend to see the tech stocks take back a lot of that investor capital.
Yeah, we did see hints of that on a week or two earlier in the spring, and we were hopeful you'd see that broadening, because you really do need to see that broadening in order for this market advance to be sustainable. We suspect it will be, but there were a couple of weeks in there where the tech names did not perform very well and the broader market did, and we would expect to see that. We need to see that on a more sustainable basis for this to continue, because it definitely is hard and it's nerve-wracking for everyone if the bulk of the performance is coming from just a handful of names.